Hi, I'm Chris Osmond, Chief Investment Officer, Centura Wealth Advisory. In light of geopolitical turmoil resulting from the fall of President Trump's Liberation Day tariff announcement on the White House lawn on April 2nd and the resulting sell-off across global capital markets, I want to take a few moments to provide a high-level overview of what's transpiring, but also remind investors that now is not the time to panic and make sweeping changes to your investment portfolio. Or worse, sell everything and go to cash. With that, I want to cover four main points today. So let's dig in, starting with number one. What's really going on? So tariffs are really causing a great amount of uncertainty and concern within the markets. But as of yet, the downturn in equities is really due to expectations or speculation of what might happen, not hard data about what is actually happening with fundamentals in the broader economy. Really, it's too early to tell what impact tariffs will have on the US and global economy as potential trade negotiations play out, retaliatory tariffs are implemented by other countries like China, or tariffs are potentially lifted or reduced for cooperative countries like we're hearing may happen with Japan or even South Korea. This is a very fluid situation, which is why we're seeing heightened volatility in the markets. Ultimately, markets hate uncertainty, and until we gain greater clarity with tariff policy, volatility is likely to continue. Number two, after the historic calendar years that we saw in 23 and 24, US equity markets are now in correction or even bear territory to start 2025 as a result of the uncertainty surrounding tariff policy. So where can we go from here? Well, if greater clarity on tariff outcomes is gained, or if tariffs are softened on other countries, or if Trump loses broader support and ultimately pivots on tariffs, we could see a significant rebound in US equities. Unfortunately, on the other hand, if there is no softening to projected tariffs or there are significant retaliatory measures from other countries, there will likely be a negative impact on company fundamentals and economic data like inflation, employment, or GDP, all which would likely result in further equity declines. Now, we tend to invest in stocks for greater long-term growth potential than bonds and cash. However, there is a price of admission for that growth, which is risk or volatility. In fact, equity volatility is very common and in fact normal. Since 1990, on average, the S&P 500 has experienced a drawdown of approximately 14%, yet in about 70% of those years has ended in positive territory. So this is where diversified portfolios across global asset classes remains paramount. In the current environment, asset classes like fixed income and alternatives should provide an important ballast during times of turmoil like we're experiencing today. Fixed income markets, whether taxable or municipal, should provide important downside protection as well as income production while yields are still elevated. Bonds are essentially flat year to date and serve as a critical ballast in asset allocation. Alternatives, particularly those like real estate, also provide important diversification benefits and stand to benefit from lower interest rates and even serve as a hedge against inflation, both of which are expected to occur should the current state of tariff policy remain unchanged or even worsen. And lastly, number four. As a reminder, equity markets have experienced a massive run-up in recent years, and this was driven by euphoria surrounding the Magnificent Seven and other AI tech themes. This euphoria resulted in a highly concentrated and overvalued market that was more sensitive to negative news. And unfortunately, the tariffs became the ultimate catalyst for that price compression. Though, if you think about it, the S&P is roughly at the exact same level it was just last year in April 2024. Though while this is concerning, we believe markets will eventually rebound. Though again, it's impossible to time the market, as the best days in the market tend to follow the worst. So the best strategy is to stay invested, and therefore we do not recommend making major changes to investment allocations, or worse, exiting the market. Rather, focus on diversification, asset classes like fixed income, and alternatives to help weather the storm. Rest assured, we are actively monitoring this ever-changing landscape, and we're preparing to act accordingly as we learn more. As always, if you have any questions or concerns, please don't hesitate to reach out to your advisor. And thank you for your continued trust and confidence as we navigate these uncertain times.